And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Coronavirus fears not rocking the markets too much, but take a look underneath and you'll see plenty of money that's been moving around, particularly in the world of ETFs. So what's going on? Let's ask John Davi, CIO of Astoria Portfolio Advisors, Tom Lydon, CEO of ETF Trends, also with us, Andrew Chanin, CEO of ProcureAM, Bruce Bond, CEO at Innovator ETFs. Tom, I want to start with you. In the last week, we've seen heavy volume going to ETFs that track semiconductor stocks, Japanese equities, other global markets. Explain this to us. What's going on?
Yeah, well, there's been people taking both sides of the trade, Bob. Although we haven't seen a lot of price differential, there are a lot of people that are bullish, trying to get in on this trend on the upside, but a lot of people are scared. Not great news coming out of China. Apple downgraded what their earnings might be, and that with semiconductors, we might see more slower economy over in China, which definitely is going to affect the market.
One of the reasons I watch volume, in addition to price movements, is volume can sometimes tell you a lot. So on a day where there's not a lot of movement necessarily, for example, in the Japan ETF or the Thailand ETF or the Singapore ETF, all of a sudden there's massive volume. That tells me somebody's moving some money around. Can we really deduce anything by watching these volume trends in ETFs?
It translates into uncertainty. You look at Japan, again, not good economic numbers, higher taxes in the last quarter for sure. And then we've got the Olympics coming up. At one point in time, the Olympic Committee is going to have to come forward and say, are they going to move forward on this based on the coronavirus? That's up in the air.
I'll give you an example. There were a lot of people felt that the coronavirus is not breaking out worldwide. It's largely confined to China. But a lot of people were saying, aha, we got to look for the first signs that maybe it'll break out somewhere else. So maybe it'll break out in Singapore. So that on days when I heard that around in the markets, I noticed extra volume in the Singapore ETF, for example. So I'm not saying this is an early warning sign, but it is a way of sort of gauging investor interest overall, John.
Yeah, I think if you look at all the Chinese ETFs or any countries in Asia that have a lot of economic linkage towards China, they're all down like 6 to 8%. And then if you go to like Europe, US, a lot of those, market indices are down significantly less. But I think what Tom said is right about Apple. You got to watch single name stocks that now have supply chains in China, because they're going to start to produce more guidance lower and probably hit to the earnings. So I'd watch. I think that the impact is going to spread to Europe and US.
And John, you're very big on ESG and thematic type ETFs, so clean energy, water, lithium. I've seen volume in all of these. So lithium, for example, what's going on? Is this a play off of Tesla?
I think so. I mean, LIT is up 20% year to date.
LIT is the lithium ETF.
LIT is the Global X lithium ETF. It's up 20% year to date.
What do we own here? I mean, lithium producers is the
Correct.
answer, but they're linked to the electric car industry, obviously.
Exactly, yeah. So, I mean, Tesla is, the biggest weight. It's about 11%. It's a top 3 holding. And, it's Tesla's contribution to LIT's year-to-date return, as you see on the screen, is about 10% of that. So, some people are using LIT as a way to kind of play the Tesla story in an exchange-traded, diversified wrapper.
Of course, we've seen enormous investor interest in Tesla, enormous interest. We get emails all the time. Is this going to last? Is it safe? It goes from 600 to 960 in a few days, and then down to 720, and then it's back up to 900.
Yeah.
Very difficult for a retail investor to play that. Is ETF a safer way to do it?
It probably is. I mean, I would encourage investors to have more of a globally diversified way to play thematics as opposed to picking individual stocks. It's a risk management issue, right? Putting all your eggs in Tesla versus a diversified basket.
Yeah. Let's move on here. Space is the place. Shares of space tourism firm Virgin Galactic skyrocketing this year. What's up? Andrew runs the Procure Space ETF. The symbol is UFO. Get it? Andrew, it's not just Virgin Galactic. Other space-oriented stocks, particularly satellite stocks like Iridium, Maxar, they've also been strong. But everyone's focused on Virgin Galactic. Give us 20 seconds. Is there a fundamental reason why this stock is up more than 200% this year, or is it just suddenly we're all in love with space?
I think a large part of it is supply-demand. There are only so many shares on the market. It's the only pure-play space tourism company out there accessible for public investors. And there could very well be a short squeeze as well, as you have more institutions initially initiating coverage on the stock, there's a lot more attention on that name, and it seems like a lot of that action has been buy side.
And then you get some institutional. Morgan Stanley, when they did that node a little while ago, interest just exploded, and they say analysts don't have any influence anymore. In this case, they did. Morgan Stanley moved the stock.
Space is open for business. It's an investable industry now, and yes, it has moved a lot as far as Virgin Galactic, but having an ETF gives you exposure to many companies from around the world doing all different things in different stages of their own life cycle.
And I keep talking about the fact that space is a theme this year. Maybe it's not as big as pot was, last year, thank goodness, but it's a theme. And people are interested in space. People are interested in disruptive technologies, in AI, in robotics, in genetics. And so space is now in that group of things that are attracting investor interest. I think it's wonderful. I think Elon Musk has helped almost single-handedly revive the space program. But I would also note, we've talked about this many times, satellites are also moving. Iridium, Maxar, Loral, they're all been up, and there's interest in that. What's the technology aspects of the satellites as part of the space program?
So a lot of the analysts that are covering the space industry that are expecting growth, and Morgan Stanley says $1.1 trillion by 2040, Bank of America $2.7 trillion by 2045, they believe it's going to be from broadband internet. So you look at different technologies like big data, connected devices and Internet of Things, blockchain, 5G, cloud computing, all of those things are data-intensive industries, and satellites are being utilized as these toll operators for the digital data superhighway. So going forward, these satellite companies might become a much bigger role.
So they're the method by which all of this stuff is transmitted, essentially. They're the pipes, essentially.
In many cases.
They're like the old Comcast of the day. We have pipes on the ground. The satellites are sort of the pipes in space.
That's how you're getting data from A to B in many of these examples.
Yeah. Am I accurate on that, Tom?
Yeah.
Is that the right way to look at it? I just made that up a minute ago. It's the Comcast of space.
Exactly.
Yeah, probably a bad idea. I may retract that, or I may attribute it just to you. You said it. I had nothing to do with it. All right, I deny everything.
But it is the business of space. It's more than just space travel, and the whole idea about us being able to put all these satellites up there to be able to watch everything that's going on, and as you point out, data, as we pointed out earlier, being able to watch areas of the world like China where we're not getting a lot of information. Satellites can tell us a lot as far as what's going on there.
We've seen that in China. We've seen that with Iran. We've seen that with the wildfires in Australia. It's weather. It's it's climate change. Satellites are helping us.
And when you think about everything we're looking at, essentially we're using satellites, particularly those wildfires that we saw.
Exactly. You look at Uber. It's a GPS technology that would not work without satellites. Most people don't realize yet how important that is for our infrastructure.
Now, how do you just tell me about the fund? The fund owns basically satellites as well as Virgin Galactic. You rebalance because all of a sudden Virgin Galactic is like 14% of the whole portfolio now because it's gone up so much, right?
It's
and you have to rebalance at some point, right?
So the fund rebalances quarterly and reconstitutes semi-annually. So that's all things that are taken into consideration during those times. But we didn't start off with Virgin Galactic as a 14% weighting. It just performed so well in relative comparison to the fund.
And I've noted that there are underperformers like Intelsat and Globalstar, and some of this you said has to do with how they're giving out spectrum for 5G.
Exactly. So for the 5G spectrum auction, it just recently came out towards the end of last year that the U.S. was not going to allow foreign companies to bid in that auction. So companies like Intelsat, SES, other European and other foreign satellite companies took a hit because of that.
Yeah,
but
in the middle of November, they all got killed. They just dropped like crazy.
Exactly, and another reason for UFO to have a diversified exposure to many companies because it's tough to pick the
Is there anything else besides satellites that you want to put in this? I mean, there's a sort of lack of investable vehicles here, isn't there? Isn't that the problem?
So you look at
it's like Bitcoin was 2 years ago. Actually, it's like Bitcoin still is, but.
So you do have a lot of very large players, but they might be more diversified. So your typical aerospace and defense names. So the United Launch Alliance is a partnership between Lockheed and Boeing. Most people don't realize that, but they're trying to help us get U.S. astronauts into space without relying on Russia. There's all these different groups that are working together, whether it's a small group or it's a VC group within some of these larger firms, and you do get exposure to many of those in UFO.
All right, I want to move on here. With all this turmoil around the coronavirus and slower global growth, you might be thinking, hey, this is a good time to hedge things. We've been talking about options as a way to hedge, and there's ETFs for this as well. Bruce Bond runs the Innovator Defined Outcome ETFs designed to provide investors with the growth of the equity markets, but with some built-in buffers. Bruce, you're no stranger to the ETF universe. You've co-founded PowerShares.
Yeah.
Big legend. This is a big legend in the business here. Explain a little bit about what we're doing here with Innovator Defined.
Okay, yeah, it's really very simple. Basically, it's exposure to the S&P 500 and we have 3 different buffer levels. You can get a 9% buffer, so that's the first 9%, or you can get a 15% buffer, that's the first 15%, or you can get a 30% buffer. Now that buffer is from -5 to -35%. So people that want to get in the market today and they want to have a buffer against losses, they have an opportunity to get in the market, know that they have a buffer on the downside, but they're going to have participation on the upside. There is a cap on the upside. There's no free lunch. You know, it's like the holy grail here. You know, you're going to get the upside and no downside. The cap ranges. Like for February, on the 9%, it was 13%. On the 15%, it was 8.5%, and then 7.5% for the 30% buffer. So it kind of ranges, because what you're doing is you're giving up some of your potential upside to get the downside buffer, is really what you're doing.
So I want to take an example here, because it might be easier to conceptualize. Just let's take one particular ETF. Let's take the October ETF. The symbol is POCT.
Okay.
P is in Peter, OCT. This is the power buffer for October.
Right.
It's designed to track the return of the S&P 500 up to the cap, and then it buffers investors against the first 15% of losses?
Right.
Is that right?
First 15% of losses.
Over the outcome period. Now, what's the explain what the outcome period is for this.
So you, with these particular products, you got 3 things to keep in mind. You have the outcome period, which if you buy at the beginning, it's 1 year, so a 1-year period. So like the October came the first business day of October, and it will reset the first business day of October the following year, and you'll get a new buffer and a new cap at that time. So you have the outcome period, but then you also have a buffer, and the buffer is for the power buffer, which is like PJAN, PFEB, you know, so you can know which one you own. That's the power buffer. That's a 15% buffer on the downside, and then your cap will reset depending on what the market gives you at that specific time.
Okay, now, so Bruce, let's just say I buy this right at the beginning of the period, say, and for whatever, $25, okay?
Right.
So at the end of the year, I can expect to participate in the upside up to the cap, if it goes up.
Right.
And if there's downside, I can be buffered up to 15%, is that correct?
Yeah, 15% for the one you spoke of, or 9%, or a whole 30%. But you would lose 5%, that first 5%, and then you're buffered for the rest of, you know, 30%, which is significant.
Is this before fees and expenses?
This before fees and expenses.
And Bob, just to jump in here, as you talk about this POCT, which is the October one, because the market's run up since last October, we've actually got to the situation where in order to experience the buffer on the downside, it would have to run down that much more. So if someone's interested in protecting the way you just outlined, they would go to a more current offering like the February PFEB, PFEB, which then would be more aligned with getting the 15% on the downside and the 9% on the upside for the next year. So what many people do is if they're putting this so-called insurance in place and the market continues to move on the upside, they'll roll their money over into the next month.
John, this is a pretty complicated way to hedge. Does this make sense for the average investor? Under what circumstances would you as another investor be using this?
I think this is an alternative to people that don't want to go out and buy puts and pick their own strikes and have to roll the option maturities. That's what I think this ETF is doing. You know, I think for us at Astoria Portfolio Advisors, we use a lot of alternatives. You know, we want alternatives that are consistently inversely correlated to the S&P, let's say, or to ACWI. You know, so for us, we would look at it. I mean, some of our alternatives, I would say, if you compare our year-to-date performance versus, you know, the one you just had on the screen, you know, we're doing fairly well because I think we carry well, whereas options, you know, they bleed every single day if the market doesn't go up. So I like the concept. These are structured products I used to deal with, you know, 20 years ago in a former life. But I think my advice for investors is, you know, make sure you understand, you know, the option premium, implied vols, and
it's not for amateurs.
No.
Are you benefiting from all of this interest in hedging these days? We were just doing the story all throughout the day that options activities at a record high. I mean, partly this is because there's just so many different kinds of options around.
I mean, whether you're trying to, you know, quote unquote, buffer the potential burn, or, you know, whatever you're trying to do, you know, if you're concerned about the election and you want to buffer in across the election, this is a great way to do it. You can buy a 15% buffer. If you bought the March, it's going to hold you all the way to next March. So if there's a big sell-off, you know, over the election cycle, you will be buffered against that. So yeah, or the coronavirus, you know, we're seeing it for a lot of different reasons. And people, if you think about it, 75% of the investable assets are in people's hands are right at retirement. They don't want to make their money twice. They want to be able to invest in the equity markets, get the upside of the market, and not put money at risk of a big downturn.
I think you're going to see more of this in the future. Certainly people who are baby boomers, for example, that are 65 years old, they have substantial money in the market. They're going to live to 85 another 20 years. So basically you want to stay long. You don't want to sell everything, but you need a little bit of protection against the downside. You don't want to sell everything and buy an annuity. So what do you do? I think interest in this kind of protection is going to grow.
During emotional times, Bob, you know, people do the wrong thing. And this is one of those tools that will prevent them from getting out of the market.
Jumping out,
Stay in, but you've got some downside.
I agree. Definitely more interest in hedging and finding new ways to hedge. I think you definitely have one there, Bruce.
Thanks,
and that does it for this week's ETF. I'm Bob Pisani. My thanks to all my friends, John, Tom, Andrew, and Bruce, for joining us today. And thank you for watching. You can find all of our latest videos on our website, etfedge.cnbc.com. We're back to regularly scheduled program. That's next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.